Hello, everyone. Welcome to the first chapter of Accounting Principles. Before we begin, I would like to share with you a Bible verse. So in Jeremiah chapter 29, verse 11, it says, "For I know the plans I have for you, declares the Lord, plans to prosper you and not to harm you, plans to give you hope and a future." As you know that God always has a plan for us. And I believe that you are here. This is because of God's plan for you. And he also has a plan for me, a plans to prosper us, not to harm us. So let us keep our hope and faith in God for a brighter future because he knows what is the best for us. Now, let us pray. Dear Father in heaven, as we begin our lesson today, please give the students the wisdom to understand the first chapter of accounting and help us and protect us to be safe during this pandemic. Thank you, Lord, for everything. In Jesus' name we pray. Amen. All right. So let's look at the first chapter in accounting. This is accounting in action. Now, when you heard of the word accounting, what comes to your mind? What is accounting? So accounting is said to be the language of business, okay? If we want to do business, we need accounting because it is the language to communicate between business. All right. Now, in this chapter, we're going to learn about these learning objectives. So we're going to learn about the identifying activities and user associated, with accounting, this one. And then we're going to learn about the accounting principle and assumption. And we're going to look at accounting equation, and we identify the components in the accounting equations. We will also look at the effects of business transaction on the accounting equation and the four financial statements and how they are prepared for. So in these clips, I will look at mainly on learning objective 1, 2, and 3. Right. Now let's continue. Okay, so I'll just erase all of that. When did accounting appear? Okay, when did accounting appear? Is it 1,000 years ago, 2,000 years ago, or 4,000 years ago? Actually, accounting, was found in tokens about 4,000 years ago as the evidence of transaction. So people in the history, they use token, to record the ships or cows that they exchange to each other. And then about 1,000 years later, people record accounting transaction in the account tablet. Okay, so this is the account tablet. So whenever the people exchange ships, okay, or goods, they will record in this account tablet. All right, this is kind of a summary of transactions or the summary of the inventory that have been made. There were not a lot of development until the 15th century when there was appearance of a person named Luca Pacioli. Okay, so this is called Luca Pacioli. All right. Now, Luca Pacioli, he was born in 1447. He was called the father of accounting, and he was the Italian mathematician. All right. So in 1494, he published a very famous book about, everything about arithmetic, geometry, and proportion. And in this book, he developed the double accounting bookkeeping, and he described, the methods used by merchant, and his system included in most of the accounting cycle that we use today. And also he described the use of journal, lecture, and one of his famous quote is, a person should not go to sleep until debit equal credit. Okay, so if someone asks you, who is the father of accounting? It is Luca Pacioli, all right? And he's from Italy. All right. So there are three main activities in accounting, all right? Three main activity in accounting. We have, the first one is called identification. Identification is mean you select economic events or transaction. You will look at all the transactions of the company, and then you will select, only some economic events to record it, okay? And then the second step is recording. Now this recording step, we also call it bookkeeping, okay? So another word for recording is also called bookkeeping, all right? So take note of that. And recording, what does it mean? It means we're going to record, we're going to classify and summarize. And the third step is to communicate. So after we identify the transaction, we record it in the journal, and then we're going to communicate the accounting report. So the accountant, they will prepare the accounting report, they will analyze it, and they will interpret it for the user. Okay, so they will know what does it mean. Does this company perform well or not? Okay, so again, there are three main activities in accounting: identification, recording, and communication. Now let's continue, okay? Let's continue. So let's look at the people who use the accounting data. So who uses accounting data? We have two groups of users. First is the internal users. Internal user means the people who are inside the organization. For example, the finance department or the financial managers, they need accounting data because they want to make the decision. For example, do we have enough money to pay dividend to the shareholders? Shareholders means the people who hold the shares of the company, the investor, all right? So the finance department, they have to make decision, whether they have enough money to pay dividend. Dividend is kind of interest to the shareholder, okay? Shareholder is mean investor. So they need to use accounting data to answer this question. For marketing, they need accounting data because they want to know, for example, how much price that they should charge to a new products, okay, to maximize their income. Or human resources, they need accounting information because they want to make decision whether they should increase the salary for the employees or not, or how many employees should they hire, okay? And for management, you know, we need accounting data because we want to know what kind of products that, you know, it provide the most profit to the company and what kind of products that should be eliminated, okay, should be stopped. So these are the internal user. So again, internal users mean the people who are inside your organization. Now, what about the people outside of your organization? We call them as external user. Okay, so external user, they are also interested accounting information. Now, the two main external user here we have are the investor and the creditors. Okay, so investor are those people who invest the money in your company. So why don't they need accounting information? Because they want to make the decision which company that they should invest so that they can get back a lot of, you know, interest, okay, or we call dividend. Which company is doing well in the industry right now? So they need accounting information. What about the creditors? The creditors are those, you know, who lend money to the company. So when the company needs money, they're going to go to the bank, or they will go to the financial companies to borrow money. All right. So the creditors, they need accounting information because they want to make the decision how the company can pay the debt or the interest when it is due. Can this company pay back me the debt if I lend them the money? All right. So the creditor needs accounting information, okay, to make the decision which company we should lend the money. All right. Of course, we want to lend the money to good companies who have a lot of resources. We don't want to lend money to the companies that later would be bankrupt and will not be able to pay back the debt or interest. Okay, now there are a lot of ethics in financial reporting because if the accountants did not follow the standards or the principles of accounting, then there would be some financial scandals. For example, if the accountant tried to hide some information, okay, like if the company has a loss, but the accountant say that the accountant make the financial report and it show like the company has a profit, then that is not ethical. Okay, the accountant did not follow the standards or the principle. So the ethics in financial reporting are very important. You know, just like the architecture, right? When they build a house, they need to follow some standards or principles. Accountants are also like that. Okay, when we prepare the financial reports, we need to follow the standards or the principles to make sure that we are doing according to the ethical standard, right? Now, so in the US, okay, in the US, we have the generally accepted accounting principles, okay, generally accepted accounting principle. And if you can see, it is GAAP, okay? This is GAAP, okay? So we call it GAAP, okay? GAAP, GAAP, or we call it GAAP, all right? So what does it mean by GAAP? It's generally accepted accounting principle, all right? GAAP is from the US, okay, class? It's from the US. So what is this generally accepted accounting principle? They are the standards that are generally accepted and universally practiced. These standards indicate how to report economic events, all right? So who are setting this standard? We have the FASB, okay? Or we call it Financial Accounting Standard Board, okay? So the FASB, they are an organization that is responsible to set up the standards for accounting, all right? We call it generally accepted accounting principle, and this is popular in the US. All right, what about for other countries? Other countries, we also have some standards. It's called International Accounting Standards Board, or we call it IASB, okay, IASB. International Accounting Reporting Standard, okay? And this international reporting standard is setting by the International Accounting Standard Board, all right? International Accounting Standard Board set the International Financial Reporting Standard, right? Let me write down for you. So we have International Financial Reporting Standard. Okay, this one we call it IFRS, all right? These are the standards that are set up by the International Accounting Standards Board. Right? Okay, let's continue. Let's continue, okay? So let's look at the principle. Let me erase this first. So we have two measurement principles in accounting. We have historical cost principle and the fair value principle. Okay, historical cost principle and the fair value principle. So the historical cost principle is also called cost principle. It's also called cost principle. So the cost principle say, we need to record assets at their cost. Okay, we need to record assets at their cost. So for example, if you go out to, let's say Mukhlek, and buy a table, okay, that costs 1,000 baht. All right. Now, next day, the cost of the table increased to 1,500 baht. Okay. So, which one you should record? 1,000 baht or 1,500 baht? So according to the historical cost principle, we should record assets at their cost. So it means that when we bought the table, the cost was 1,000 baht. So in that case, we need to record the table at 1,000 baht instead of 1,500 baht when the price increase next day. Okay, so this is called cost principle. Record assets at their cost. Now next we have fair value principle. Fair value principle say assets and liability should be reported at fair value. Is the price received to sell the assets or settle a liability. Okay, now this principle mostly is used for stock or bond for investment securities. Okay, so when you buy the stock, all right, those assets, you can report it at fair value. Fair value is mean the price, that is selling at the market. Okay. For example, the price of the stock is 100 today, but tomorrow is increased to 150. So you can record is as 150 at fair value. Okay. The price received to sell an asset or settle a liability. Okay, selection of which principle to follow generally relates to trade-off between relevance and faithful. Now let's look at the assumptions in accounting. Okay, assumption in accounting. So we have two assumptions here. We have monetary assumption, unit assumption, and economic entity assumption. A monetary unit assumption is say we only record accounting transaction that can be expressed in terms of money. So it means that, for example, in the business, there are a lot of transactions, a lot of events, okay, economic events. So you need to select those economic events that can be expressed in terms of money and to record it, okay? For example, a customer go to the store and then look around the store. Okay, so this is an event, right? But it's not an economic event that we need to record because it cannot be expressed in terms of money. All right. Now, another example, for example, we pay the salary to the employees, $200. Now, this is a transaction that can be expressed in terms of money. So we need to record it. All right. So monetary unit assumptions say we only include transactions that can be expressed in terms of money. Now let's look at economic entity assumption. Economic entity assumptions say activities of entity should be kept separate and distinct from activity of its owner and our own others entities. Okay, so it say like this: the activity of the company should be separated from the activity of the owner. Okay, for example, let's say the owner of the company go to supermarket, okay, with his family, and he shops and pays $200. Okay, so should we record this transaction in the companies? The answer is no, because this is the activity of the owner. It should be kept separated from the activity of the business. Okay, another example, the company purchased a car for $10,000, right? So should we record that? Yes, because this is an activity of the company. All right. So remember that the activity of the owner should be kept separated from the activity of the business. We call it economic entity assumption. Now, there are three types of business we have. We have proprietorship, partnership, and corporation. Okay, three types of business: proprietorship, partnership, and corporation. So what is proprietorship? Proprietorship is mean the business is owned by one person. We call it proprietorship. Okay. For example, if I open a bookshop, okay, I invest $10,000 and open a bookshop. This bookshop is the proprietorship because it is owned by one person. Okay. So normally the owner is often the managers or the operator, and the owner will receive any profits and suffer any loss, and is personally liable for all the debt. So if my business has profit, have income, then I will get it. If my business has a loss, then I have to suffer for any loss. And the business or the person, the owner, is personally liable for all the debt. It means that if the business goes bankrupt, okay, so I will have to be responsible to pay back the debt personally, okay? So I have to sell my house, my car, I have to take the money from my bank account to pay for the debt of the business. So we call it the owner is personally liable for all the debt, okay? Now, next we have partnership. So partnership is all by two or more people, okay? Partnership is all by two or more people. For example, Mr. A and Mrs. B, okay, they are friends, so they come together and they open restaurant, all right? So this restaurant are owned by two or more people. So this is called partnership. Normally, it is a retail or service type business, like restaurant or hair salon, or other type of service business, like repairing shops, okay? So normally the partners will have generally unlimited personal liability, okay? What does it mean by generally unlimited personal liability? It means that if the partnerships, okay, or if the business goes bankrupt, if it cannot survive anymore, then the partners, they have to be responsible to pay back the debt of the business from their personal resources. It means that they have to, pay for the debt of the partnership from their bank account, from selling their car, their house, to pay for the debt, to pay for the creditors. And for the partnership, they need to sign a business, a partnership agreement, okay? So what is partnership agreement is, in that agreement, it will tell how much profit that each partner will be, divided. For example, if, the partners agree to divide the profit 50% and 50%, or 70% and 30%, or 60% and 30%, 60% and 40%. So it will be written in the partnership agreement. All right, so that is the partnership. Now next we have the corporation. Well, for corporation, we will have so many owners, okay? Those who purchase the shares of the company or the stock of the company, they will become the owner of the corporation, okay? So the owners, we call them investor also, or shareholder, okay? So the owners are those who purchase the shares or the stock of the corporation. And the corporation are owned by many people, all right? So it has, corporation has separate legal entity organized under state corporation law, and it has limited liability. Now this is different, yeah, class. The other one, they have, unlimited liability, like partnership, okay, have unlimited liability. Okay, proprietorship also unlimited liability, but corporation is have limited liability. So what does it mean by limited liability? So limited liability, it means if the stockholder invests $400 into this corporation, if this corporation goes bankrupt, the stockholder will be responsible to pay back for the debt of the corporation up to $400 only. Okay, so they don't have to sell their houses, they don't have to sell their cars or use the money from their bank account to pay for the debt of the corporation when the corporation goes bankrupt. So they are only responsible to pay back the debt up to the amount that they invest in this corporation. All right. If they invest $500, they will be responsible up to $500. If they invest $1,000, they will be responsible up to $1,000. All right. Okay, so let's try to summarize again. We have three types of business here: proprietorship, partnership, corporation. Okay, proprietorship, it means the company that is owned by one person. Partnership, it means the company that owned by two or more people. And corporation is mean the business that is owned by many people. Okay, whoever buy the shares of the company. All right. Now, which type of business have unlimited liability? You want to know? It is proprietorship and partnership. Okay, proprietorship and partnership has unlimited liability. Okay, it means that when the companies go bankrupt, they have to sell their own assets or their own resources to pay back the company debt. Okay, so proprietorship and partnership has unlimited liability, but corporation has limited liability. Okay, corporation has limited liability. All right, now let's look at the accounting equation. Okay, so the accounting equation is the most important equation in accounting. Okay, everyone who study accounting needs to understand the accounting equation. Okay, so accounting equations say assets equal liability plus owner equity. Okay, assets equal to liabilities plus owner's equity. Now, what is assets? Assets is mean the resources of the company. All right. Liability means the debts of the company. And the owner's equity means the ownerships or the investment of the owners to the company. All right. So let me give you an example. Okay, so I would go to this. If I have assets, we equal to liability plus owner equity. Okay, so I can write down here assets equal to liability okay. And so for example, if I invest, let's say if I invest $1,000 in the business, we call it cash in the business. Okay, so $1,000 cash, you know, assets is the resources, right? So I have cash of $1,000. It's my assets. All right. Now, because I invest 1,000 cash in the business, owner equity, it means the ownership. So it means I own $1,000 in this business. Okay. Now, if the company buy an equipment, okay, let's say the company buy a computer for $500, okay, and owe money, okay, and owe money to the shop. So now I have an asset, which is the computer. Okay, computer is this an equipment truly. So I have an asset of $500, but I owe money to the shop. So it means I have a debt, right? Liability is mean debt. So I have a debt or a liability of $500. Okay, so you can see that assets always equal to liability plus owner equity. Okay, so first 1,000 equal to 1,000 here on the right side. 500 computer equal to 500 debt of liability. All right, so the total here we have will be 1,500 on the left side and 1,500 on the right side, right? So this is called the accounting equation. All right, now let's continue. So assets mean the resources that a business owns, okay? And it will provide future service or benefits. For example, cash, supplies, or equipment, all right? So I will explain more clearly about this. So let's look at assets, okay? So we say assets is the resources that the business owns, remember that? Okay, so I'll put it yellow. So it include what? Cash, account receivable, supply, equipment, machine, motor vehicle, building, and land. Now, what does it mean? Okay, now let's look at the first one, cash. Cash is mean the money that the company has. Okay, so money here can be in terms of paper money, we call cash, or sometimes it can be the cash as bank. Cash as bank is mean the money that you deposit, at the bank. So we call it cash. Okay, so cash can be cash at bank or the physical cash. All right. Before I explain account receivable, maybe I'll do it later. Okay, let's look at supplies first. Okay, so what is supplies? Supplies means those things that you use in running the business. We call it supply. So for example, you have pencil, you have pen, okay, papers, super glue or something. It is called supplies. Okay, so supply is kind of stationary. Okay, stationary, those things that we use in running the business. Okay, we call it supplies. And next we have equipment. Okay, equipment, for example, can be computer, or any equipment that you use in your business. Okay, we call it equipment. Machinery. Okay, if you have a machine at your factory, it will be called machinery, and it is an asset. Okay, and next we have motor vehicle. Okay, motor vehicle. For example, you have a motorbike. All right, we call it motor vehicle. Building. All right, building. If you have an office in the building, you own that building, so that will be called building. Land. Okay, land. All right, so all of these we call it assets. Now let's look at account receivable. What does it mean by account receivable? Okay, for example, company A purchase, let's say it's a bookstore, okay? Company A purchased 1,000 of books from company B, okay? Or maybe we say that company A sells $1,000 of book to company B, all right? Now, company B doesn't have money, but it has a good relationship with company A. So company B promised to pay $1,000 to company B, to company A in the future, okay? All right. So this $1,000 is become account receivable. Okay, of $1,000 in company A. Okay, so what does it mean by account receivable? Account receivable is mean the amount of money that company A expect to receive from the customer. Customer is being company B in the future. So we call it account receivable. So is this also an asset for the company because we expect we're going to receive it in the future, right? Again, company A sell $1,000 of books to company B, but company B doesn't have money to pay for company A yet. So it promised to pay $1,000 to company A in the future. So it means that company A is going to receive $1,000 in the future, okay? So company A will have an account receivable of $1,000, okay? And this is recorded in company A. So account receivable will be 1,000 for company A. So what does it mean by account receivable? It means the money that the company expect to receive from its customer in the future. We call it account receivable. Okay, so again, account receivable is mean the money, okay, the money that a company expect to receive in the future from its customer. We call it account receivable. Oh, I forgot one more thing we have is the inventory. Okay, inventory is also an asset. So inventory means those things that you buy from other companies or you produce by yourself and you sell it to the customer. So it should be on the shelf. Okay, so we call it inventory. All right, inventory. For example, if you are selling book, okay, so books will be your inventory. If you sell CD players, so CD players will be your inventory. If you sell TV, TV will be your inventory, okay? So what is the difference between inventory and supplies? Well, inventory are those things that you buy from others or you produce it and then you sell it to the customer, all right? But supplies are those things that we purchase, okay? And then we use in the business, okay? You see the difference? For example, supplies, if we use some pencils, okay, we use it in the business, so it will be supplies, all right? Okay, now let's look at the second one. It's called liability, okay? Liability is mean debt or obligations that the company have to others. For example, we have account receivable and note receivable. Okay. Now, what is account receivable? Account receivable is mean the money that the company promised to pay to the supplier in the future. Okay, we call it account payable. Okay, again, one more time. Account payable is mean the money that a company promised to pay its customer in the future. Sorry, to pay its supplier in the future. Okay, so for example, in this example, okay, company B promised to pay company A $1,000 in the future. So company B will have an account payable of $1,000. Okay, this is a debt to company A. All right. Okay, company B will have an account payable of 1,000, a debt to company A. And company A will have account receivable of 1,000, okay, from company B. So what is the difference again? So account receivable is mean the amount that company A expect to receive from company B in the future, okay? What is account payable? Accounts payable, it means the amount of money that company B promised to pay to company A in the future, but it has not paid yet, okay? It's old money, okay, to company A. So we call it account payable. And then we have note payable, all right? So what is note payable? Note payable, it means, for example, if company C, okay, so we have company C. Company C goes to the bank and borrow $10,000 with 10% of interest per year. Okay, so in this case, okay, company C has a note payable of $10,000. So note payable is like this. So company C will sign a note with the bank that it promised to pay $10,000 to the bank with the interest rate of 10% per year in the future. Okay, so in this case, company has a note payable. It means it owes money to the bank, $10,000. All right. Now, what is the difference between account payable and note payable? So account payable and note payable, they are both debt, okay, of the company. It means you owe money to someone. But for note payable, the difference is you need to pay back interest, okay, for account payable note, all right? For account payable, because you have good relationship with the supplier, so you promise that you will pay in the future to the supplier, but there's no interest. But for note payable, normally when you borrow money, a big amount of money from the bank, then you will have to pay the amount of debt with interest. So we call it note payable. Okay, you sign a note with the bank or a financial company and promise that you're going to pay that in the future. So we call it note payable. All right. Okay, so again, assets as main resources of business, we have cash, account receivable, inventory, supply, equipment, machine, motor vehicle, building, land. Liability is include accounts payable and note payable. they are both debts of the companies. But for note payable, it is the debt that needs to pay back with interest. Okay. Now let's look at owner equity. Okay. Owner equity is called the ownership. It's the ownership or the investment of the owner. Okay. So we have owner's capital. Owner capital is mean the initial investment of the company, drawing, revenue, and expenses. So owner equity is include 4 of this. Okay, owner's capital, drawing, revenues, and expenses. Okay, so if, for example, you invest 1,000, in a company to establish your company. Okay, for example, if I want to open my business and I invest $1,000 in my business to start. Okay, so I have an owner's capital of $1,000. Okay, so the more I invest, okay, the more I invest is the investment of the owner. The more I invest to the company, the owner capital will increase. Okay, so I would say that owner capital will increase, owner equity increase. Okay, the more I invest to the company, the more owner equity will be. All right. Drawings means the money that the owner withdraw from the business. So for example, you are the owner of the company and you would like to withdraw $1,000 from the company. So it will be drawings. So the more money that you withdraw from the business, it will make the owner equity decrease. Okay, it will cause owner equity decrease. All right. It will make owner equity decrease. All right. And what about revenues? Okay. Revenue is mean the amount of money that we get or we receive when we sell a product or when we provide a service to the customer. So the more revenue that we have, our owner equity will increase, right? Okay, so for example, the more money that you earn, okay, this means your ownership will increase. Okay, so we say the more revenue that we have, owner equity will increase. Okay, what about expenses? Expenses is the thing that we need to pay for our business. Okay, so for example, we need to pay the salary for the employees. We need to pay the gasoline or something like that. The more expenses we have, owner equity will decrease. Okay, so owner's equity are influenced by 4 things: owner's capital, drawing, revenue, and expenses. Okay, the more investment from the owner, what happen? Our owner capital will increase. Drawings, if the owner withdraw more money from the business, our owner equity will decrease. If we earn a lot of money when we sell the products or when we provide the service, okay, so revenue will increase. And when revenue increase, what happens? Owner equity will increase. Okay, if we pay a lot of expenses, you know what happened? Our owner equity will decrease. Okay, now revenues, again, revenue is mean the amount of money that you get when you sell something to the customer or when you provide a service to the customer. So let's say you provide a service to a customer okay, for let's say $300, like fixing a car. Okay, so your revenue will be $300. Okay, but then we have to pay some expenses. So what is the expenses that we need to pay? For example, we have to pay for the rent, expense, you know, we have to rent the shop, you know, so it will be $100 per month. And if we pay for the salary for our worker, so we have salary expense. And so for example, salary will be $100. So we're going to have a net income, okay? A net income of $100. So it will be $300 minus $100 and minus another $100. 44, and so we get $100. Okay, net income is mean the profit that you get, okay, when the revenue is more than expenses. If the revenue is less than the expenses, then we will have a loss. We call it net loss. Okay, net loss is happen when revenue is less than expenses, right? And sometimes we also call it profit, net profit. Okay, net profit is the same as net income. Okay. All right, so let's look at the PowerPoint again. Okay, we talk about assets. We talk about liability is the debt or obligation. We have account payable, note payable, salary and wages payable, interest payable. Have a lot of, you know, payable. If you see the word payable, it means it's liability. Okay, liability. Okay, and then we have owner's equity. So owner equity is include the investment by owner, revenue, drawing, and expenses. Okay, now remember investment by owner and revenue, it increase owner equity. Drawing and expenses is decrease owner equity. Okay, owner equity, what is that? It's the ownership, okay, of the owners, or the investment of the owners. So we can rewrite the accounting equation by saying assets equal to liability plus owner's capitals minus owner's drawing plus revenues and minus expenses. Okay. Assets equal to liability plus owner equity, you know, owner equity, increase owner equity, right? So we say plus owner capital minus owner drawing, because owner drawing will reduce owner equity, plus revenue minus expenses. Yeah. Now revenue minus expenses, we call it net income or net loss. Okay, so what is revenue again? Revenue is mean the money that you receive when you sell some products, or when you provide, or when you earn the money when you provide a service to the customer. Okay, so drawing is mean we withdraw cash or other assets for personal use. Expenses is mean you know, those assets that we consume or service that we use when we generate the revenues. For example, if we use the gasoline, or if we use the worker, so we have salary expense or gasoline expense. Okay, now let's try with this one. Classify the following items as investment by owner, owner's drawings, revenues, expenses, then indicate whether each item increases or decreases the owner's equity. So we have rent expense. Okay, so what is that? Rent expense, it says on expense, and it will decrease the owner equity. What about service revenue? Remember revenue? It should be a revenue here. And what happened to equity? It will increase the equity. And we have drawings. Drawing is classified to owner's drawing and it decrease owner equity. Salary and wages expense is classified expense and is decrease the owner equity. Okay, so that's all for the clip, the first part of chapter 1, and we're going to continue with the second part of chapter 1 soon. All right, okay, thank you so much everyone. See you in the next clip of chapter 1. We have one more, okay?